Hello, this is Dr. Annette Moultrie, and thank you for visiting my channel. Also, thank you again for watching my videos. Please subscribe, like, comment, and share. Thank you.
But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. Welcome to Chapter 12, Part 2, Partnerships. Again, welcome to Part 2 of Chapter 12, Partnerships. Learning Objective 12.2, account for the startup of a partnership and prepare partnership financial statements. What partnerships organize? Forming a partnership is easy. It requires no permission from the government and requires no outside legal assistance. However, it's important that you enlist an attorney to draw up the partnership agreement. A partnership combines the contributed assets and abilities of the partners. When a partnership begins, partners may contribute both assets and liabilities. Now, these contributions are generalized the same way as for a sole proprietorship. Debit the assets and credit the liabilities. The excess, assets minus liabilities, it measures each partner's capital contribution. Suppose Gina Bright and Martin Gonzalez form a partnership to sell computer software on June 1st, 2025. The partners agree on the values shown on this slide that you see. Wright's contribution is cash, $15,000, merchandise inventory, $40,000, AP, $80,000. The current market value for these items equal Bright's values. Computer equipment costs $80,000, accumulated depreciation, $20,000, market value, $55,000. And with Gonzalez's contribution, he's contributing $2,000. Office furniture costs $20,000. Accumulated depreciation, $1,500. The current market value for Gonzalez's contribution is $18,000. The partnership records the partner's contribution at current market value. Why? Why do we do that? Well, it's because the partnership is receiving the assets and assuming the liabilities at their current market values. For Sheila Bright's contribution, the partnership records a debit to cash for $15,000, a debit to merchandise inventory for $40,000, a debit to computer equipment for $55,000, a credit to accounts payable for $80,000, and a credit to Bright Capital for the difference, which is $30,000. For Martin Gonzalez, the partnership records a debit to cash for $2,000, a debit to office furniture for $18,000, and a credit to Gonzalez Capital for $20,000. Partnership financial statements are similar to the statements of a sole proprietorship, but with the following differences. A partnership equity statement is referred to as the statement of partners' equity. Sometimes we call it statement of partners' capital. The statement of partners' equity shows the changes in each partner's capital account for a specific period of time. A partnership balance sheet reports a separate capital account for each partner. Here you see in Exhibit 12.3, it's a balance sheet for Bright and Gonzalez. The initial partnership balance sheet for Bright and Gonzalez as of June 1st, 2025 is what you see here. Now notice that the balance for each partner is listed separately. It's listed separately in the partner's equity section of the balance sheet. Learning Objective 12.3, allocate profits and losses to the partners. So how are partnership profits and losses allocated? How are they allocated? Well, allocating profits and losses among partners can be challenging. The partners can agree to any profit and loss sharing method they desire. Some of the typical arrangements are sharing of profits and losses based on a stated ratio for each partner, such as 50-50 for two partners, or 4-3-3 for three partners, which means first add the parts 4 plus 3 plus 3 parts for the 10 parts, total parts. So 4/10 to partner A, and 3/10 to partner B, and 3/10 to partner C. Sharing based on each partner's capital balance, sharing based on each partner's service, sharing based on a combination of stated ratios, capital balances, and service. If the partners, if they have no partnership agreement specifying how to divide the profits and losses, then they share equally. If the partnership agreement specifies a method for sharing profits but no losses, then losses are shared the same way as profits. The partnership agreement may state each partner's ratio of profits and losses. Suppose Bright and Gonzalez allocate 2/3 of the profits and losses to Bright and 1/3 to Gonzalez. Now, this sharing rule can also be expressed as 2/3, okay? If the partnership's net income for the year was $60,000, Bright and Gonzalez would share the net income based on the ratios using this formula that you see here. So the allocation of net income based on stated ratio is equal to net income times the stated ratio. So therefore, the allocation to Bright would be $60,000 times 2/3, which will be $40,000 for Bright. And the allocation to Gonzalez would be $60,000 times 1/3, which will be $20,000 for Gonzalez. The entry to close net income represented as a credit balance in income summary to the partner's capital accounts would require a debit to income summary for $60,000, a credit to Bright Capital for $40,000, and a credit to Gonzalez Capital for $20,000. So that's how you would actually close the income summary. If instead the partnership had a net loss of $18,000, say if the partnership had a net loss of $18,000, the income summary account would have a debit balance of $18,000 prior to closing it. In that case, the partner's capital accounts would be reduced by their percentage of the loss. Using the ratios from previous slides, the allocation would be $18,000 times 2/3, which will give you $12,000. So that $12,000 would be a debit to Bright Capital. And then you would multiply $18,000 times 1/3, which will give you $6,000. And that would be a debit to Gonzalez Capital. So it would be a debit of $12,000 to Bright Capital, $6,000 debit to Gonzalez, and a credit of $18,000 to income summary. In a partnership, one partner may contribute more capital. We've seen that. Therefore, the profits and losses may be divided based on the partner's capital balance instead of on a stated ratio. Now, we know that Bright contributed $30,000 in capital and Gonzalez contributed $20,000. So allocation based on capital balances uses the ratio of the partner's balances to the total capital. So what you would do is that the allocation of net income based on capital balance is equal to net income times capital balance divided by total capital. So the allocation for Bright would be $60,000 times $30,000, which is the capital that she contributed, plus $20,000 equal $36,000. And the allocation to Gonzalez would be $60,000 times $20,000 divided by $20,000 divided by $30,000 plus $20,000, which will give you $24,000. So in other words, it'll be $60,000 times the $20,000 divided by $50,000, which will give you $24,000 for Gonzalez. Now, as we have seen, allocation of net income can be based on stated ratios or on capital balances. It can also be based on a combination of services, capital balances, and stated ratios. A partnership might want to use this method if one partner contributes more capital, but the other partner devotes more time to the business by managing the day-to-day operations or handling the accounting. Now, one way to reward a partner who provides services to the partnership is by offering a salary allowance called a guaranteed payment, in addition to an allocation based on capital. As the partnership agreement specifies 3 steps, all 3 steps must be performed whenever the partnership allocates profits or losses. The partnership's net income for the first year is still $60,000, but the partners share profits based on services, capital balances, and a stated ratio. So as you see here, the partnership's net income for the first year, it is still the $60,000, but it's still the $60,000, but the partners, they share profits based on services, capital balance, and a stated ratio. Notice here that the net income, which is a loss, is allocated to each partner, and it should equal the total net income loss. So you see here, they're sharing it, okay? The $15,000. Half up to 15 is the $7,500. So in this case, $26,500 is allocated to Bright, and $33,500 is allocated to Gonzalez. So when you add Bright and Gonzalez, the $26,500 and the $33,500, $60,000 net income. For this allocation of the $60,000 profit, the closing entry would debit income summary for $60,000, credit Bright Capital for $26,500, and then credit Gonzalez Capital for $33,500. Now, what happens if this same income sharing agreement were in place, but Bright and Gonzalez incurred a total net loss of $18,000? See the net loss of $18,000? Now, because the partnership agreement has 3 steps, the allocation of net loss also goes along with all 3 steps. So per the partnership agreement, Bright will receive an allocation of $16,000. This would be the salary, okay, for extra work that she has done for the partnership. Gonzalez will receive the $24,000. In addition, each partner will be allocated interest of $10,000. I'm sorry, 10%. 10%. So Bright will be 30,000 times the 10%, and Gonzalez's capital 20,000 times the 10%. This is it right here. Okay. So after these allocations, the profit and loss sharing ratio will be applied to the unallocated profit or loss. For this allocation of the $18,000 loss, the closing entry would debit Bright Capital for $12,500, debit Gonzalez Capital for $5,500, and credit income summary for $18,000. Assume that Sheena Bright and Martin Gonzalez each made withdrawals of $3,000. They both made withdrawals. The partnership records a debit to Bright. It would be a debit to Bright withdrawals for $3,000, and the same for Gonzalez. So they both will be debited for $3,000 to withdrawals, and there would be a credit to cash for $6,000. And that's when a partner withdraws cash. The withdrawal accounts are closed at the end of the period, exactly as they are for a sole proprietorship. That's where you credit each partner's withdrawal account, and then you debit his or her capital account. So you see here, there's a debit for both Bright and Gonzalez capital, and a credit to Bright and Gonzalez withdrawals. Remember that the statement of partners' equity shows changes in each partner's capital account for a specific period of time. Now, unlike a sole proprietorship statement of owner's equity, the statement of partners' equity shows each partner's capital account separately, including partner contribution, net income allocation, and partner withdrawals. Here you see at Exhibit 12.4, it actually shows Bright and Gonzalez statement of partners' equity, assuming that $60,000 net income is allocated based on service, capital balances, and stated ratio. This is the end of part 2. So in part 2, we covered learning objective 3 and 4. Stay tuned for part 3 of chapter 12, which deals with partnership. Thank you for watching. And please, if you haven't already, please click the subscribe button below.